Hi traders, and welcome back to part 2 of the position sizing series. My name is Marco Meyer from Trading Educators. So first of all, if you didn't watch part 1 of this series, I suggest you do so before watching this video, because in part 1 I covered the basics of what we will use today. So here's a quick review of what we did. We had a look at what is the range, what's the average range, what is the difference between the range and the true range, and then finally, what's the average true range and what exactly is initial risk. There's also an article you can go to. Right below here you can see the URL where I'm going to explain this in a written format. Let's do a quick summary of part 1. I clearly explained how the average true range is calculated and what exactly it tells us. Now the conclusion regarding the average true range is that it's an indicator that gives us a pretty good estimate of the price fluctuations we can expect in the next trading period or next trading periods. Most of the time, but of course there are exceptions to this, and I want to have a quick look at a price chart to show you what I mean. Now here's a daily price chart of the E-mini S&P future, and I've plotted in some indicators right below. First of all, you can see the true range of a single price bar. So this one shows us the true range of every single bar. Right today so far we have a true range of about 21 points. And below you can see the average true range of the last 10 periods. So if we look at yesterday where the bar closed, we had a true range of about 21.25. And what you can see at the bottom is the difference between the 10 period average true range and the actual true range on the next price bar. So if we look at this bar, for example, here, you can see we had a true range here of about 11-12 points. And the average true range of the previous price bar was about 22 points. So on this price bar we had only about 50% of the average true range. This is the difference of what we would look for. So in other words, if you use the average true range to get an idea of the next price bar's volatility, you want to be as close to 100% as possible. So in the days before that, it was almost exactly 100%. We got exactly the volatility we would have expected on each of the price bars. But of course there are differences, because on some days you'll have strong rising volatility. Like on this price bar, for example, we had about 100 almost 170% of the average true range of the previous price bar. So on this price bar, the market was much more volatile than what we would have estimated using the average true range. And you have the opposite of that, where on this price bar, for example, we had barely 50% of what we would have expected. You can also see it right on the chart. It's a very small, tiny bar. Now today, as you can see, we are already almost at 100%. So in other words, the market already moved what we would have estimated it to move. Now what I wanted to show you with that is that on most of the time, the average true range gives us a pretty good estimate of price movements, as you can see. So there are days where we have 25% more or less than what the average true range would have told us. And of course, there are some outliers, like last year in August, where the market got very volatile very quickly. But on average, most of the time, it's a very good indicator to give us an idea about what kind of volatility to expect. Now to move on to the next part, I want to make some assumptions here and some simplifications, because this is quite a complex topic and there are a lot of nuances you have to actually look at in the real world. But I'm going to break this down now to something that we can work with so that I can get the concept over to you I want to get over. Now the first one is we're trading only one method at a time. So we don't trade multiple methods or systems, but we have one way we're trading. And we also don't trade multiple open positions in highly correlated markets. So we usually only have one position or a couple of positions in markets that are not correlated. And after looking at our historical trades and backtests, we have decided already that we want a risk of about 1% per trade, which is going to give us the right balance between the profits we want and the drawdowns we can live with and accept. Also, we are trading a $200,000 account. So 1% of that we would risk $2,000 per trade. We also assume that each trade market we're trading is equal. So we don't want to give any trades or markets more weight, but our goal really is to have each trade with the same significance, with the same weight. Now, let's say we see finally a trade emerging, we see a trade setup, and in our example, it's a chart pattern, it's going to be a trader's trig entry. How do we determine our position size? What's the right way to do this? Now, here's the way that, from my experience, most retail traders use to determine this. And what they do is they simply look at a price setup. For example, here, this would be a trader's trig entry in the Euro future. They have a look at where they would get in. Then they figure out where they would get stopped out of the trade, where the trade wouldn't work anymore in their opinion. They would take the difference between these two. In this case, it's going to be about 80 ticks. Multiplied by $12.50, we would have a risk of $1,000. Then they take that $1,000 and divide it by what they want to risk. So in our case, it's going to be 80 ticks equals $1,000. So we would want to trade 2 contracts. Now the question is, does that really make sense? You won't see anyone in the professional trading world doing it like that. And there's good reasons for this, and we're going to go into that now. Now here we're looking at the dollar index future daily price chart, and we have a nice trader's trig entry set up here. The trader's trig entry bar here is a very small bar, as you can see. Compared to the last couple of bars, it's really tiny, and also compared to the average, it's a quite small bar. So if we would calculate our position size based on the difference between our entry point here at 96.48 and our exit, where we would put the stop at 96.91, we would have a stop loss of barely 86 ticks. That's fine. Now the problem is, if we use that stop loss to calculate our position size, we will have much more risk in the market. Then we would have a price bar that was like this big. In this case, we would place a stop above the price bar, and we would have a much smaller risk because the difference between the entry point and the stop loss point would be much bigger. And the question is, do you want that, and does it make any sense? And I don't think it's a good idea to do this. Just because if you do it that way, you're going to give trades with small stops that require a relatively small stop compared to other trades much more weight, which you probably don't really want to do. And this is going to result in trades that require larger stops being much more less relevant than trades with tiny stops. Now, if we look at the average true range here in US dollars, this instead gives us a pretty good idea of what to actually expect. So my suggestion is that instead of using the difference between the entry point and the stop loss to determine the position size, put the stop here, it's all fine, that's why you want to get out of the trade, but when it comes to calculating the position size, have a look at the volatility instead. And using the average true range in US dollars here, we would get a risk of about $800. So this would mean, wanting to risk $2,000, we would trade 2 contracts here. And that's exactly what you want, because the odds are much bigger you're going to get stopped out with a full loss if the stop loss is tiny than if you use a larger stop loss. So there's a direct correlation between the size of your stop loss and the odds of getting stopped out. Alright, so here's the conclusion. The initial risk of the trade, so we're talking about the entry to the stop, doesn't have to and shouldn't determine your position size if it's based on a price pattern or the high-low of a single price bar. Now, of course, if you also place your stop loss right on the average true range, then it's all fine and you have that included already. But if you don't, it's something you want to consider. Why? Simply because doing it that way ignores market volatility. And market volatility gives you a much better idea what your actual risk is, and so you don't want to ignore that. Now, why is that so? And it's so because the actual risk to get stopped out with the full loss of what we want to risk, in this case 1%, $2,000, will be much higher on trades with a tight initial stop loss, where we're going to have a big position size, than with trades with an accidentally wide initial stop loss, small position size. In other words, we don't want to have more risk on just because a price bar is a little bit smaller than another price bar. It doesn't make any sense whatsoever. And at the same time, of course, the same is true for the potential reward. So doing it that way with trades that have a tight initial stop, we would have a big position size on, and we would have a much higher potential reward than with trades that have accidentally a wide initial stop where we would have a small position size on. Again, doesn't make sense, that's not what we want. No, we don't want that. Otherwise, the trades with an accidentally wide stop where we have a small position size will have much less weight compared to the trades with a small stop, where we're going to have a big position size. A much better solution to determine the position size is to use one that's based on the actual ongoing volatility in the market by using the average true range, for example. This way, you're going to have risk based on the ongoing volatility, and that's much more realistic and makes a lot more sense. And by using that concept, you can improve your results a lot, especially when it comes to getting more stable results, because otherwise you're always going to have some trades that's going to have an unproportional large risk, and you're going to have some trades that have very little risk compared to what kind of move to expect within the trade. This is going to help you even more once you start trading multiple markets and multiple trading methods or systems, because it gives you something to normalize your risk on. So you can start to target a certain portfolio volatility, for example, and you're going to have something to measure it with regardless of the method you're trading. So in other words, you might have very different trading methods. You might trade a chart pattern, you might trade support resistance, you might trade some statistical approach, but now you're going to have something to normalize that risk on. You're going to have a common denominator on which you now can base your position sizing, regardless of the setup you're trading. So that was part 2 of the position sizing series. I might do part 3 someday, but for now I think I gave you a pretty good basic understanding you can work with. So if you didn't do so, you might want to join us at tradingeducators.com, where you're going to find our trading blog, forum, ebooks, articles, and you can sign up for our educational newsletter, ChartScan. I also want to invite you to check out www.algostrats.com, which is a new project that I've been working on for quite a while already and that is going to go live soon. It's going to be focused on algorithmic trading strategies, and there's already a newsletter you can sign up to. And if you do so, you're going to get informed about any news regarding the project. Also, when AlgoStrats is going live, there will be a limited test period that you can participate in for free. Now, if that sounds interesting to you, go there, sign up, and you'll stay up to date. Besides that, you can also follow me on Twitter by going to twitter.com/algostrats or on facebook.com/algostrats. And of course, if you didn't do so already, go ahead and subscribe to our YouTube channel at youtube.com/tradingeducators. This way you're always going to get informed whenever we put a new video on there. Alright, so thanks for watching and see you next time. Take care.